Hello and welcome to this episode of Akrinos Access Live. I'm your host, Eric Matei, joined today by Adam Cmejla, CFP. Adam is the founder of Integrated Planning and Wealth Management, and he's joining me today for a conversation all around owner financing. And really, we're posing this question, is owner financing right for your practice? So as usual, y'all, we love for these to be engaging, interactive conversations. So please, if you're tuning in live across any of the socials, please drop any questions there in the comments, and we'll try to get them here brought into the fold. So for starters, Adam, how are you?
I'm living the dream, Eric. Thank you for having me. And I did get your memo that this is a Blue Shirt Wednesday presentation.
Blue Shirt Wednesday.
I like the fact that
Absolutely.
Well, happy to be here. Thanks again for the invite, and looking forward to the conversation today.
Awesome. Yeah, man. Well, look, I know we've got a lot of really great things to get into. So let's maybe kick off the conversation with just start by defining owner financing, exactly what it is and how it works.
You know, sometimes I think we try to be too smart with these definitions and we look past what the actual wording of it is. It's kind of like retained earnings. When you look at a balance sheet, I'll hear practice, well, what are retained earnings? Like, they're earnings that we retain in the business, hence retained earnings. So what is owner financing? Well, it is financing that we provide as the owner. So essentially the owner is wearing another hat as the bank rather than a buyer going out and procuring financing from one of the big banks, regional banks, a local bank, or a credit union. You essentially are drawing up the terms of that note, drawing up the loan covenants, assigning an interest rate, a term, et cetera, and you are essentially acting as the bank so that the buyer can then pay you directly the monthly payment over, Y payment over X numbers of years to buy you out either entirely or partially, and we'll talk about the different ways in which you can do that. But that's all it is. It doesn't have to be any more complicated than that, right?
Fantastic. I figured you've got a marvelous way of really kind of bringing things down, simple, easy to understand terms. And I think certainly, as you alluded to, and later in our conversation here, we'll really dig into like understanding if this is an appropriate, a prudent use of the funds, right? Because the whole concept of owner financing presupposes that as the owner seller, you do have a bunch of cash on the sideline. It's then a question of, do you want to invest there as the bank or elsewhere? But we're going to get to that. And I know you got some great insights to share there. But let's maybe start. Let's maybe start by also maybe kicking off this conversation around just the transition process. So many of our viewers out there are looking to sell practices. Many of them also are finding opportunities to purchase practices. So why don't you take a few minutes to just kind of explain what the practice transition process looks like?
So the three rocks essentially that you have in this process are the valuation, the negotiation, the implementation of the process. The valuation is in that order, right? So the valuation is when, depending on where you are at in that process, essentially whether you're the instigator in the process, if you were the buyer and you were the one, you and I both know buyers that have cold called practices saying, hey, are you interested in selling? Hey, are you interested in selling? Hey, are you interested in selling? Yeah, I just might. Great. Let me do it. So it depends on which person is facilitating and kind of getting that momentum going. The first thing that we have to do is we have to understand the value of the asset that we're looking to buy or sell, again, depending on what role that we're in. So getting a valuation is important. There's three different types of valuations that you can get. There's an income-based valuation, a market-based valuation, or an asset-based valuation. Those are the broad three strokes that you can have. A decent valuation is going to include is going to include all of those, and then you're going to have kind of a common number or a confluence number, right? And not really an average, but you're just going to kind of mix all those together, homogenize it, and end up with a fair market value of the practice. As is often said in small and medium business financing, a business is worth zero. A small and medium-sized business is worth zero until you have a willing buyer that is willing to buy it. So we need to understand what we're going to start with. And then we switch into the negotiation. The keystone of the negotiation process is formally submitting that letter of intent. The letter of intent is going to include the purchase price. It's going to include the timeline. It's going to include assets that are included, real estate and lease, as well as how much earnest money that you're going to put into that process. A red flag on the LOI, this is something that I know we're talking about owner financing, but I've seen it happen and I want to emphasize it. there is something called price anchoring that happens, right? From a seller standpoint, this is arguably going to be the most important journey and important transaction of your entire life, more so than your house, more so than any commercial real estate, because of just the emotional connection that you have to this business and to this
Sure.
practice. So letters of intent, even though technically, legally they are, and again, I'm not an attorney, I don't play one on TV, I didn't stay at a Holiday Inn Express last night. So even though,
But
but
you've been around.
I've been around the block enough to know how
Yeah,
this
you've
works.
been around more than a few of these deals. Absolutely.
That was the comedic insertion of a disclosure there. Um, uh, be careful from a buyer's perspective. If you're the one that is going to be obviously submitting that letter of intent to buy the business, be careful about succumbing to the about expeditiously going through that process just to get a letter of intent without doing your full due diligence. Because
Sure.
yes, while technically legally a letter of intent is a non-legal binding contract, you remember, what did I say? What's one of the components of that? It's the purchase price. And the minute that seller sees your initial offer, they will mentally and emotionally and financially anchor to that price. And
Gotcha.
so if you come back and change that down the road, can you legally do that? Yeah. But
Right.
what do we think is going to actually happen throughout the course of that process? How's that seller going to feel? It's like, wait, your LOI said 750 and now you're coming back at 695? Like, what? Be thorough and fire the best shot, the right shot, the first time around. And then lastly, implementation. That's going to be obviously the proverbial exchanging of the keys. You now have the practice. Be prepared for staff turnover. Don't change much in 90 days. Get your feet under you. Just kind of begin getting that flywheel going. And I know we could probably do an entire session on just those three things alone.
Oh,
But
absolutely.
high
Love it.
level, those are the three chapters of the transition process.
Cool. So, okay. So that being said, and for our audience out there, again, if you're just tuning in, y'all, we're hanging out with Adam Cmejla here, talking about owner financing and figuring out, like, is it right for your practice? So whether you're selling a practice or whether perhaps you found a practice that you're looking to purchase, we're talking about just now what the transition process looks like. Again, to Adam's point, there's three stages, starting with evaluation to come up with that equitable price. From there, prompting negotiation, and ultimately implementation. And he also dropped some really important insights you want to hang on there as well, regarding particularly due diligence and the fact that there's not
Yes.
only financial due diligence, but also legal due diligence and practice management due diligence, which whole other kettle of fish. But okay, so now let's dig a little deeper and let's talk about this in the context of financing options, both some of the more common financing options as well as some of the less common financing options. And also, Adam, if you would please, as you're sharing that, maybe share some of the pros and cons of each option available.
Sure. I mean, in all honesty, the two most popular ways of financing the purchase of a practice, and this is just a purchase of a business. Obviously, we're talking about the applicability to an optometric practice. You're either going to find someone else to lend you the money or you're going to do it yourself, right? This comes back to that seller financing.
Sure.
If the buyer is going out and procuring outside financing through a bank, credit union, again, national, regional, I don't want to say it doesn't really matter, but in the context of this, all under that umbrella, you're going to be leveraging someone else's money. The things that I like about that from the seller's perspective, most importantly, it deleverages your risk. You're not predicating the success of that practice. And this is especially important when you are doing what we call a walk away or a buy sell 100% transition. I'm buying your practice, Eric, 100% right now, and then you're going to retire, exit stage left, off into the sunset. It's nothing but golf and beaches from here on out. I don't like seller financing in those situations, if for no other reason than your ability to collect on the sale of your practice, Eric, is 100% dependent on my ability to not run it into the ground. And
Sure.
despite
Yeah.
the overwhelming success of optometric private practices, and this is evident by banks providing 100% financing, typically up to 80% of trailing 12 revenue, right? But 100% financing of the purchase price, I like transferring that risk to someone else rather than me. So even though, is it probable that they would run that in the ground? No. Is it possible? Absolutely. I've had a couple of situations here in Indianapolis, not ones that we've worked on, but through the optometric community here locally, where that has happened. The owner bought the practice and eventually staff left, couldn't hire new staff, patients went somewhere else, and within 4 years, practice was done. That's
Wow.
not the only story.
Sure.
So
Yeah.
that's the reason that I don't like seller financing in the 100% walk away. Other than that, I like it if the situation fits. The other different ways in which you can use seller financing are when you do like, um, well, actually, I might be getting ahead of myself here a little bit, but let's let me talk a little bit more about the other ways, right? So when we're doing bank financing in that sense, like I said, you have the bank that's going to be coming in and providing 100% of financing, and some of these banks are even offering working capital above and beyond. So you buy the practice, and then you still want to have 50, $75,000 in your checking account, right? Working capital, kind of going back to that definition of like, well, that sounds complicated. What is that? It's like, well, it's capital that you can use to work in the business, hence working capital, right? Cash in the bank, my friends. That's what we're talking about here. Um, I like doing those situations again, just because we're transferring that risk from a buyer's perspective. It takes the emotion out of the equation. From
Yeah.
the seller's perspective, the disadvantage to doing bank financing is you're going to realize 100% of the value in one single tax year. And so typically your tax bill, if you do bank financing and you, again, whether you're doing 25%, 50%, the amount of equity that you're buying, or excuse me, that you're selling really doesn't matter. Whatever dollar amount that you receive in bank financing, the bank is typically just going to write you one check for whatever
Sure.
value it is, for whatever. And so you're going to realize that as income on whatever tax year. The double whammy there is if you're selling the practice and the real estate all in one transaction. In those types of deals, what we love to see happen is you sell the practice in one tax year and then you sell the real estate next tax year. Best case scenario to make that happen: close on the practice on December 31st, sell the real estate January 2nd. Right, 2 different tax years, transactions are 72 hours apart, but essentially you've now split those proceeds up over 2 different tax years.
Yeah. Yeah.
Take a breath here, ask for any thoughts and feedback on your
Well,
end.
what I was going to mention there, for viewers out there that are at that stage, and you're looking to sell your practice and sail off into the sunset, as Adam was mentioned. We actually did. Adam and I. Adam joined me on Akrinos Access. Go back, look in the archives. We actually have a 3-part series around planning that exit. So it's tax strategies for the exit. So definitely, I want to go tune into that, where Adam takes a deep dive into kind of this 3-year process, or this 3-stage process to really optimize your tax strategy. Because to his point, this is going to be the single biggest payday of your life, and Uncle Sam's definitely going to want to get their piece of it. So, okay, so fascinating stuff here. Let's get to talking about. Let's get to talking then. Anything else from the financing options, right? So you talked about the traditional bank and the importance of understanding tax strategies there. Credit union presumably falls under a traditional banking model.
Yeah.
Yeah.
Yeah, I really haven't seen too many differences there on the credit
Sure.
union versus the versus bank side. You might, if you have a deeper relationship with your credit union, you might be able to get maybe somewhat better terms, which is on par with typically what we've seen clients. Sometimes your small local bank that you have a relationship with, from a buyer's perspective, you might actually be able to get as good, if not better, of a deal by your local bank than you would through some of the national banks. Again, every situation is different.
Sure.
What I would emphasize more so on the banking, more so on the banking side than seller financing. And again, deeper conversation for a different time, but let me just plant the seed right here. It's not all just about the interest rate. There's more to financing than just the interest rate. There are loan covenants. There are contingencies. There's prepayment. Like, that's a whole nother talk in and of itself. All I
Absolutely.
want you to anchor to, ODs watching right now, is there is more to the loan. There's more to the loan than just your interest rate.
One more time. There's more to the loan than just the interest
than
rate.
just the interest rate.
As a matter of fact, we should probably let's connect and do for you to unpack that. Unless you wanted to, if there's anything more to elaborate here, or we can entertain another episode.
No,
But
I
I think it
think
would be fascinating to explore.
Yeah, I think to connect the dots, kind of the relationship between seller financing versus, where you're banking on yourself as the seller, where you're being the bank, versus versus going the traditional financing. There are still guardrails that you have to be inside. The IRS has very, very clear rules around how you do this. So you can't just cut a deal with your associate and say, hey, you've been really good to me over the years, so I'm going to sell you this at a 1% interest rate, amortized over. Like, no, you have to color inside the lines. There are rules, there are guardrails around how you do seller financing, so that you are applying a nominal interest rate, that you do have loans. the common phrase with seller financing, and obviously this isn't an issue with bank financing because, well, you're working with a bank and they have rules, regulations, and procedures and policies on seller financing. Get it in writing. This is not handshake deals. This is not cocktail napkin type conversations and documents and legal agreements that you have. Get it in writing. Work with a team, even though you are doing it. Maybe it's a buddy, maybe it's maybe it's your associate that's been there for 10 years and we're like, oh, I don't want to get legal involved. I don't want to mess up the relationship that we have. We're good pals. We'll do this the right way. Whether it's in the estate planning process, I've seen families get torn apart because of money. I've seen partnerships erode because of money. When you get the dollars involved that we're talking about here, you are doing all of yourselves, all parties involved, a disservice by not bringing a disinterested third party into the equation to help steward and guide you through that process.
Absolutely.
So get it in writing, all of it, the covenants, the bylaws, the contingencies, all of that. Get that in writing on seller financing.
So let's talk now a little bit as we're starting to dig deeper into seller financing. Why don't we talk a little bit about structure and timeline, and also, again, please reference also, Adam, share. Again, really excited to have you on this episode because I know you've been a part of a lot of these deals. So share what you've seen, pros and cons, what works well, what doesn't work well. Again, as we start to look at kind of the structure and timeline of how to orchestrate this.
So I would say and people are probably not going to like my answer to this, but given that we don't have an hour and a half to just sit here and go through everything, and again, I'm arbitrarily picking an hour and a half, I'll reemphasize what I just said. Get it in writing. Ambiguity is one of the worst things, one of the worst variables that you can have in these types of transactions. So when we think about the different structures and timelines, there's really only 4 ways that you can transition a business. There's the walk away, which we already talked about, which is where I'm not a fan of seller financing. If you're doing 100% walk away, meaning I'm buying your practice, Eric, and then you're going to leave and I'm going to take it over from day one, or maybe you stick around for 90 days to just kind of help with the transition. But I have zero, you don't want to work and I don't want you to work, right? We're exiting, we're parting ways as friends. You got yours, I get mine. We're
not parting ways as friends, just
correct.
No longer.
Yeah. Correct. The walk away is right. The walk away is where I do like bank financing, again, just for that business risk. The other 3 ways that you can essentially transition to practice, and the percentages don't matter because that's part of the negotiation process. Side note on negotiations, he or she who has more options typically wins. But on the it doesn't matter what percentage you really have. Like, let's just use 50-50 as the example in the first 2, and then the last one is a separate one. So 50-50 partnership means I'm going to buy in 50% right now, Eric, and we are essentially going to be partners in perpetuity until one of us decides to retire or sell. But there's no defined timeline in our partnership.
Sure.
The other version of that, the derivative of that is, all right, it's a 50-50 buy-in, or maybe it's a 25-75 buy-in, or 20-80, whatever that is. But there's a clear timeline in the PA, in the purchase agreement, that says, all right, Eric, I'm going to buy into your practice at 25% at this valuation, and you're going to retire within 5 years and sell the other 75% of me, or sell the other 75% to me, right? Not to somebody else, to me, right? That goes back to the clarity and making sure that we have terms and agreement in place, that there's no ambiguity. Because to play devil's advocate here, if we just do this cocktail napkin and, oh yeah, I'll buy 75%, or I'll buy 25%, I'll work for 5 years, and then I'll sell the other 75. Great, that sounds good. 2 years later, Eric, you reconnect with your longtime optometry friend and classmate that decided to move back to the town that he was from, which just happens to be where our practice is located, and you decide to sell 25% to him. I'm like, whoa, that wasn't part. You can see where these can unravel and create an incredible amount of friction. And if there are any attorneys on the call right now, I apologize, but the only people that typically win in those situations are the attorneys that arbitrate the deals. Because, so those are the other 2. Make sure, again, that you have the 50%, 25% buy-in, whatever that is, and then there's a clear timeline for the phase out. And then last but not least is essentially 100% sale, and I become an associate. we flip. Let's say that I own the practice 100%. You've been the associate in my practice. And now we essentially want to reverse roles. I'm done. I don't want to own the business anymore. I don't want to work on the business anymore, Eric, but I still love patient care. I still love working in the business. And I'd sure love the opportunity to continue working in my soon to be your practice. But I want you to do all this stuff on the ownership side of things. I just want to see patients. So can we do that? Great. Yes, let's do a 100% owner to associate role. So you buy 100%. I still, in that situation, that is the derivative of the situation where I would be okay potentially with doing owner financing because I'm still involved.
Sure.
There's still risk in that though, right? Because even though I'm involved, I legally have no ownership say. I could see you running this practice into the ground based off my 30 years of ownership experience, but I can't do a damn thing about it because you own it. So again, it's a case by case basis. Just understand the risk reward involved in that. Hopefully from a tax standpoint, because this is where owners will go when they think about seller financing, they get anchored, right? Bringing back that anchor principle. They get anchored to this idea of, gosh, if I do seller financing over 5 years, it means I can defer, let's just say it's $1 million. Okay. Just to make the math easy. It's $1 million. And I can, gosh, instead of realizing the taxes on $1 million right now, all in 1 year, I can spread out, just again, it's going to be more than this because of interest, et cetera, but I can spread out $200,000 over 5 years. I like that better. Okay. Are you going to pay less in taxes over that time period? Arguably, yes. Tax rates are changing at the end of 2025. So again, this is the importance of a team and doing the math and having the calculations done. You ultimately, as the seller, need to determine, is the juice worth the squeeze? Are you willing to absorb that additional amount of business and financial risk, knowing that you essentially are either going to have to be a part of the practice to insulate that risk, or if you do decide to walk away at some point in the future and now it's 100% on them without any of your input, just got to take that into consideration. But that's another option where you just want to be an associate working in the practice, not owning your practice.
Yeah. And to build on what you were mentioning a moment ago regarding the structure, like the legal side of things, right? This can't be on the back of a napkin, particularly for those options wherein there's going to be some sort of partnership period, right? Whether it's like, hey, we're 50-50 partners. There's no timeline. We're just going to be 50-50 partners until we decide to change it. Or if there is that structured, say a 5-year timeline, hey, we're going to start at 25% year one and graduate you over. In addition to that bill of sale, that purchase agreement that Adam referenced, vitally important, have that operating agreement all dialed in as well, right? Because for that period where you're both where you're going to be partners, whether you're 50-50 partner, 75-25, it does not matter. You have to have that operating agreement in place so that we have a clearly defined in writing understanding of what everyone's executive functions are, right? And Adam, I'm sure we could probably have a whole other conversation and probably get an attorney on to join us as well, having a conversation with things that unfortunately those mechanisms were not in place. And now, when those mechanisms are not in place, inevitably there's a high potential that someone will lose. I'll say that.
Well, let me ask you this, and I have a question for you, Eric, and I'm curious to hear your thoughts on this. I'll share my thoughts just to give you time to kind of formulate a response. What are your thoughts on allowing someone to buy in as an associate and essentially they don't get any, like, buy in as an associate, now they're an owner, but they don't want any of the ownership responsibilities of working on the business.
So give them
where the seller says, gosh, this is a really good OD, and I feel like the only way that I can retain this person, they want ownership. They're an associate. They've been with me for 5, 10, 15 years, whatever that is. I'm 10 years out from retirement. I really don't want to lose them. They want ownership. But through that conversation process, through that dating process, and I think you and I would both agree that's a very important part of this relationship.
Sure.
If you're going to be married, i.e. partners for a while, you should have some type of dating relationship. And by the way, dating is different when you've now expressed an ownership possibility into that equation. The terms of your relationship have changed. So during that dating process, you find out that they want ownership. They want their cake and they want to eat it too. They want to be paid like an owner, but they don't necessarily want any of the ownership responsibilities that come with it. Essentially, those are still going to fall back to you because, well, let's face it, inertia is a very powerful force. I'm personally not a fan of that. I think if you're going to have ownership, if you're going to extend ownership opportunities to an associate, that is awesome. And I think you should absolutely do that if the situation is right for it. But I do believe that there should be part of that negotiation process is you as the owner taking administrative inventory of what you do as an owner and saying, okay, what on this list that I work on as the owner, that I'm working on the business strategically and tactically, what am I now going to abdicate for myself and essentially shift over
Sure.
to the
Yeah.
new partner, which would be, to what you're saying, part of the operating agreement to say who's going to do what and when does it need to get done in the practice. What are your thoughts on that? I know we're deviating a little bit slightly, but it's all with
Yeah, no. This is really great because while I say I disagree, but we agree.
Okay, tell me more.
Okay, so no. I realize, and by the way, the agreement comes from because when you first mentioned it, look, what is that? That's it's a stock binny. Like if in other words, like if you're looking in the corporate world, right? If you're looking in the corporate world, that would be the same thing as like a stock option, right? Like being gifted stock, equity in the enterprise at your whatever anniversary, or perhaps you've earned them somehow. So, we can conceptualize that to the practice, to the small business as being just what you just said. And I think we probably share in a liking that, wow, yeah, there's some vested interest there. But I'm realizing we're agreeing on the same things. You said you're not a fan of it, but I think you are a fan of it because I think you do agree that it's good to give people ownership and opportunity to empower themselves, right?
I think people should have ownership if they're willing to own.
And that's what I was going to
Ownership
say.
means
And
working
yeah,
and wearing another hat in the case of owning a business. Because if you have this, and we've got a couple of client relationships going through this process right now with their associates, where the associate wants to buy in, the seller is a little hesitant to do it because the new associate doesn't. They one of two things is happening. Either A, they want to discount on the value of the practice because they feel like they're buying some of the equity back,
sure.
which I adamantly disagree with because associate, you got paid exactly what you asked for the
With
work that
zero
you
risk, that
provided in
entire
the business.
period. Yeah.
Exactly.
Mhm.
You didn't build it. They came. The pay, like, different conversation. I rustled some feathers. My recent episode on 2020 money. Actually, I think this one's coming up. So there's a new episode of 2020 money coming up, which I actually dive into the details of this exact phenomenon that I see happen far too often. The cousin to that in this conversation is you want ownership and you want to be paid like an owner without essentially having to do any of the work as an owner. That's my disconnect. Does that make sense? Do you agree?
Yeah. No, I'm with you 100%. And that's what I was going to say. I think where this becomes the big issue, really, and it goes back to it's got to be in writing. Because where this comes in issue is that, yeah, like you've gifted them some equity with zero executive function, but also presumably if that's occurring, there's no timeline. Right. And that's where, and this is where, and I'll ask you, Adam. I mean, what's your take on? Because I know we work closely with a number of practices that have come up with some really novel ways to for sweat equity, right? That buy-in
Yeah.
piece. Now I will say this: the instances where we're seeing it and it's working well is because you do have that associate that is hungry to become the owner.
Correct.
Hey, yeah, I'll start pay me 4 days a week. Fridays goes towards my equity in the business. A lot of different ways to write this, but what's your take on that as far as that sweat equity piece for someone that is hungry and wants to be on the path? Your take there? Or are you still like not a fan? Like, no,
I'm not a fan of it.
Okay.
And this goes back to the previous week's episode of 2020 Money 2 weeks ago,
Sure.
where I basically, you can't value a business based on potential. Like,
True.
think of the show Fixer Upper, right? When I buy a piece of real estate, I'm not buying it based off potential. I'm buying it at fair market value.
Yeah.
Period. Full stop.
Yeah.
And then now that I have ownership of this asset, now I invest the sweat equity, the time, the money, the resources to build it to to build to its potential.
Yes.
So I'm
Yes.
not a fan, and maybe we're saying this, maybe I'm saying different things, or maybe not answering the question directly, or answering a different question than what you asked. I find that the sweat equity way of doing it leaves a lot of ambiguity. I think it can be hard to document, where is this line? How do I value my time? Well, you took 8 hours to do this project, Eric, but I could do that in 4 hours. So your time that you spent on Friday doing this project,
Sure.
that's worth. You think it's
Yeah.
worth the full amount. I think it's like, I just feel like there's too much ambiguity that can happen in the situation. I would rather have the clean break, the clean divestiture of equity on the front end, and then collectively now have a rising tide lifts all ships, where we are now owners working towards the same common goal, and now we're both rising with that.
Yeah.
I'm curious to hear
Well,
from your perspective, what works, what have you seen work on the
well,
sweat equity side of things?
and I think where this becomes really, really interesting, Adam, is to consider. I think this is the model for those practice owners where, like, hey, you've been in practice ownership for 20 or 25 years, so you're presumably like in your 50s, and you've got that associate, so you see yourself still having 5, 8, 10, 12 years in patient care, but you also have the foresight, having witnessed what we have witnessed with how optometry, and for that matter, all of healthcare. I mean, we're seeing this. We've seen private equity, corporate hospital buyouts and stuff. We're seeing a lot of that come in, and I think what we're coming to discover now is we're seeing how that's impacting a lot of things: cost of care, patient care, provider burnout, or what have you. That's another conversation. But as it pertains to paving the way for private practice, and as we're discovering this excitement, I had a conversation recently with the folks over at Jobson. And they have all the access to all this data, and it's tremendously exciting to see this surge of interest of, like, okay, we learned what we did with that experiment, and now there's this rebirth of peer-to-peer, doctor-to-doctor. Let's build practices. Let's establish legacies and communities. That's going to provide care. That's going to grow communities, right? So that's where I feel like, perhaps, and again, Adam, hey, look, man, I don't know. Maybe it's up to us to, like, really chart this out. Like, okay, if you want to have this all, and I've seen a lot of different, not so much back of the napkin, but kind of like, I mean, you can make models around a plethora of different things. But, this opportunity for, again, you've been in practice for 20 or 25 years. You still see you're going to keep kicking butt. Your associate has worked their tail off. They want to become an owner. They also have a mortgage, have a young family, have babies or small children. Let's get them on the path to ownership. And something that I really think is going to do amazing things for the future of private practice, we need to get this transition process started earlier, so that we don't have owners wait until age 65. I want to be out yesterday trying to scramble and make this stuff happen. But, like, let's start having the conversations when you're, so I don't know. We need to explore this more.
Well, the other challenge that I have with the sweat equity model of it is, it's the only model where the seller doesn't get a pot of money up front. I mean, it's an incredible amount.
It's the long
trust.
game, definitely.
Yes,
absolutely.
You're putting an incredible amount of trust in this transaction, because every other process that we've talked about, every other way of transitioning ownership of the practice, whether it's seller financing or bank financing, whether it's 100% or 25% or 50% over X numbers of years, the common denominator in all of those variables is that I, as the seller, am getting X numbers of dollars in Y number of years, whether it's all up front or, I'm getting $20,000 a month for the next X numbers of years, whatever that purchase is. On the sweat equity side of it, I'm essentially paying you in stock, and I'm not getting anything for it right now.
True.
I'm banking, quite literally, on a smaller piece of a much bigger pie at some point in the future when I sell. So, like, can it be done? Absolutely. You and I both know of practices that have done that. I just wonder, is that the best option, or is that, do I dare say, is that a last resort option, or what are the variables? What are the conditions of the practice that would make that be the viable option?
Sure.
That's a semi-rhetorical question, because I know we're going long in the tooth here.
Fascinating. Definitely, we should continue to explore that. So, okay, so getting back to owner financing.
Yep.
And let's start to drive this home. But before we drive this home with these last few areas, as far as, like, look, key considerations to determine which option to use. And hey, if you are going to go the owner financing route, where to start, financial elements, what have you. We had a question come in actually that was dropped earlier in the week. Dr. Doug Walker. I've had the pleasure of meeting Dr. Walker just over the years, being around the industry. He's got an amazing practice up there on the Oregon coast, and beautiful practice, as a matter of fact. I mean, it is for sale. And
yes, it is.
Dr. Walker, if you're tuning in live or catching the replay, hello. And by the way, if you are a young OD looking for an opportunity to move to the Oregon coast, reach out to Dr. Walker. Really amazing practice that he's built. But his question is this, Adam. What are the most common conditions to put in that sale contract to protect the seller from buyer default? And I think that is probably the number one question that all sellers that are entertaining this is it. What, if anything, can I put in my contract to protect me from that buyer defaulting if I indeed owner finance this?
It's a good question. And it's a hard one to answer. And I know Doug's not going to like that answer. I mean, look, this is where we get into this is the importance of the professional team. And this is where, as an advisor, and again, I don't mean to play this card as a way to completely deflect from the question, but it is going to get into the legal terms of that agreement. I think that what's the phrase? The best defense is a good offense. Is that the way that I'm thinking about this correct? Like, the amount of due diligence that should be done on the front end is amplified when you're doing 100% seller financing to know what buyer, because essentially after you sell the business, I don't know that there are really many covenants that you're going to be able to put in place there that are going to protect you from, like, at the end of the day, you can't stop someone from making bad decisions.
Right.
They are the legal owner of that business. And if they make a fundamentally bonehead decision, like what's one that arguably could be a good or bad decision? You took every vision care plan under the sun, Doug, and I'm going to buy it. I'm going straight cash pay. No, you shouldn't do that. Vision care, it's an advertising expense, right? All these things, like, nope. I've heard it. I'm done with VCPs. I'm out. Exit stage left. You're like, no, don't do that. Like, can you build into the loan covenants, into the purchase agreement that says you have to keep X numbers of vision plans for a period of time? Again, I'm not an attorney, so I candidly don't know how far you can take. On one hand, I'm inclined to say, hey, these PAs, these purchase agreements, as long as it's not violating any type of state statute, and every state has different statutes. And again, this is where an attorney can guide you through that. If two parties agree to it and you both sign on the bottom line, there aren't a lot of things that I think would be off the table. But
sure. Yeah.
Again, I hate to dodge that question, but outside of doing an incredible amount of due diligence and dating on the front end to know what it is that this person's intentions are going to be after purchase, and that you're training them on what has worked well in the business, and understanding from their perspective, what opportunities do you see in my business that I haven't taken advantage of which, by the way, you're not going to get paid on, right? We don't get paid on potential. We don't get paid on opportunity, but
right.
Just to get an idea, that's the best answer that I can give right now. And Doug, it may not be the entirety of what you were looking for, but it is a good question, and one that, if anything, emphasizes the importance of having a team.
Yeah, and I say, Adam, it's very similar to situations where there was things of doctors cold starting a practice. Perhaps they found a piece of real estate on a property that is yet to be developed. And yet they have to give those deposits to the developers, the contractors, like before there's even a shovel in the ground.
Right.
So this is definitely legal. And by the way, because the question came through earlier in the week, and I've been kind of thinking about it, like really like racking my brain. But it's definitely that's a lawyer thing. And I guess, Adam, I'm curious, because I know as it pertains to that other scenario I just shared, we get legal involved. And then there are ways that you can like hold those deposits in escrow so as to have those timelines. Hey, if ground's not broke here, it goes back to, I don't, are there any limits to what can be held in escrow? Like, could you hold an owner finance? And I'm just kind of thinking out loud here. I don't know. Maybe that's
I don't know that I've try that again. I don't know that I have seen any specific limits on what can be held in escrow. Kind of goes back to, hey, if both parties agree to it.
Yeah. Right. Yeah.
Then you can hold that in escrow.
Sure.
But it certainly is a viable option.
Sure. Yeah, yeah. I think this is also very fascinating, knowing that Dr. Walker is looking to sell his practice as countless doctors across the nation are looking to do. I think it really is. Now, I think it's important for us to understand what these options are, what these opportunities are. And quite frankly, if we got people that want to buy practices, we got people wanting to sell practices, and we need to find better ways to make them meet. And whether that's through novel ways of financing the deal, and I know we have probably some bankers tuning in here, or novel ways. I don't know. Maybe we come, who knows? Maybe we come back to this whole sweat equity concept. Maybe there's a novel thing there. But I will say this before we kind of, Adam, I think this is the longest we've ever gone. You and I, we've had some long talks too. I think we're breaking barriers
has
here.
Not been one of my strong suits, and I apologize. But I hope, with that limitation being said, that the words that I do say, while they may be plentiful, still pack value.
Oh, absolutely, and, always. So, okay. So, any last thoughts on anything else anyone should understand? And maybe we'll kind of close it out with this. What are the key considerations if you're really thinking about this owner financing? Like, let's kind of leave folks with like a crash course. And then certainly, by the way, y'all, everybody stay tuned. Adam's going to give his contact info if you want to reach out, continue the conversation. But maybe let's kind of wrap it up here content wise, Adam, with talking about, okay, I've thought this through. I think I want to do owner financing. What are those steps?
So I think about it in 3 chapters: the beginning, during, and end. So the beginning side, and again, all of this is going to be under the purview and umbrella of making sure that that there's agreement and that there's clarity on the terms, that there's nothing left to interpretation or misinterpretation or ambiguity. So on the beginning side of it, I don't like it. Oh, well, I'm going to continue to work until I don't want to. Decide, what does this look like? Is this a 50-50 partnership? Is this an earnout? If it is, when am I going to sell, right? Document the timeline, the purchase price, the interest rate. Am I going to work? Am I not going to work? If I am going to work, clear line of demarcations between the roles and responsibilities in the practice under the new operating agreement, kind of back to what we had talked about earlier. So defining the terms on the front end. The during part of it, is there going to be a prepayment penalty? If 2 years into a 5-year or 10-year seller finance, if the doctor comes to you and says, the buying doctor says, I bought it from you, Eric, 2 years in, and you're thinking that you're going to get essentially an annuity payment for the next 10 years from me. And I decide to say, you know what? No, we're good. I got big bank over here that's going to essentially call your note, and I'm going to have them carry the note. Here's your $700,000 after, that's left off of $1 million purchase price. Agree. Are there prepayment penalties? Is there a prepayment clause? Can you do that? Can't you do that? If you do, what does it look like? If you're going to be in a partnership, what happens if I decide that I want to kick you out? Do you get a premium, which you should? Should you get a premium value? So instead of getting 100% of the 75% value, should you get 110% or 115% or 120%? On the other side, if you decide to come out or if I decide to, or if you decide to buy me out ahead of time, maybe I get a discount because I get that flip around. I should get the premium. You should get the discount, right? On who gets to call the shots, and then is there a discount or premium on the price relative to who's calling that? On the end side of things, there's not a whole lot that happens at the end, because again, we have the term of the note. Just make sure that there is that prepayment clause. If there is a balloon, so sometimes you can see a deal where, hey, I'm going to do a 10-year amortized note, but on a 5-year rate. And so I'm going to pay this for over 5 years, but essentially the rate is only fixed for 5 years. So there might be a balloon payment at the end. Do I refinance it, essentially seller at that time, or do I force you to go to a bank and finance it for the remaining? That would be weird. Candidly, I don't think I've ever seen that, but it is possible. Sure. The last thing that I'll say is you can do in certain situations when you do have a practice that has where essentially you can't get you can't get bank financing because the value of the practice is so much that it exceeds the 80% of previous 12 months collected revenues. Then what you would do is you'd have what's called a seller carry, where let's say the value of the practice is $2 million, but the bank will only underwrite 1.7 of that. Well, you as the seller can carry the other $300,000. Possible? Absolutely. Happens all the time. Same common thing. Have the terms of that in writing. What happens before and what happens during, most specifically prepayment. And last but certainly not least, make sure that you put if you own real estate, understand what the real estate play is on the overall transaction. Does the buyer want to eventually buy the real estate? If there is, make sure that you have a first right of refusal in that purchase agreement to ensure that the now owner has the ability to buy the real estate, that you can't turn around and sell your building to another optometrist down the street or someone else, right? You have to have that first right of refusal.
Sure. Yeah.
That was a lot. Sorry.
Yeah, I mean, really. So, Adam, if we can pull it all together and answer the question, is owner financing right for my practice?
Absolutely. 100% for everybody. No, I'm kidding, obviously.
Said no one never.
Said no one ever, right?
I think it's a big maybe. And really, look, the takeaway for our viewers out there, as with everything, is like, look, it's an amazing time to be in private practice. It's an amazing time to transition to practice. We are seeing the largest transition of practice ownership ever. And there's a lot of ways to go about it. And it's important, I think, now more than ever for us to really start to think outside of the box of finding ways to make these deals happen, right? And there's a lot of ways to go about it. So, hey, Adam, as we kind of wrap things up, why don't you share a little bit about how folks can get in touch with you if they want to take the conversation forward, and also a little bit about, the scope of work that you all do over there at Integrated.
Yeah. Thank you again, Eric, for the platform and for allowing me to share in the conversation. Our whole intention as a firm is to help optometrists, optometric private practice owners plan life on purpose, personally and professionally. And hopefully in the context of today's conversation, if anything, yes, I know I've shared a lot. I think it's a lot of information. I think highly of myself. I think it was good information. My point in sharing all this information the goal of that isn't to ensure that you, as the listener, as the viewer, know exactly what to do. My goal is that hopefully it sparks you to ask the right questions about your practice. And then it becomes a who, not how conversation of who do I need to align myself with to help solve this, not exactly how do I do this. And when you find your who, now you know what questions to ask, because hopefully I've kind of created a few little nuggets that you can anchor to going forward when you have those conversations. IntegratedPWM.com is our website where you can find all of the information. I produced the podcast 20/20 Money, 20/money, as if you're refracted down to 20/20 Acuity. Just search 20/20 Money on any podcasting app. We have close to 250 episodes. And despite having 250 episodes, I can't tell you how much content we have that is still in production and still behind the queue. So you have been a multiple time guest on that, Eric. I appreciate all of your insight. Again, the goal of that is to help optometrists plan life on purpose and make the best decision you can with the money in the practice and in your personal life. Make the best decision the first time around. So everything is on the website there, integratedpwm.com.
Awesome, amazing stuff. Adam Cmejla, thank you so much for joining us here on Akrinos Access for a really, really insightful, really inspiring conversation also around, this whole topic of owner financing. Is it right for your practice? Is it right for your transition?
Yep.
Folks,
last thing, can I see what? So we are in the eighth, ninth inning of launching the 20/20 Money membership. So if you are interested, if you listen to the podcast, I've been talking about it for quite some time. It's been on the front end, or it's been on the front burner, back burner, mid burner, front burner, back. Like, we've kind of cycled it around, but we are getting close to launching the 20/20 Money membership, which is all about helping ODs earlier on in their career make the right decision the first time, become brilliant at the basics, and learn the ABCs and 1, 2, 3s of both personal and professional finance. So more of that is on the website as well.
Yeah, everything right there, integratedpwm.com. Also, if you want to connect with Adam, I know he's always open, as our team here at Akrinos is. Adam is always open to connecting with new doctors and having a nice conversation, just understand your situation and perhaps providing some insight into the path forward. So, Adam, again, thank you so much for joining us here on Akrinos Access Live. To our viewers, thank you for tuning in. And if you're looking for more great practice management insights and modern practice solutions, check it all out at akrinos.com. Definitely follow us on the socials to be the first to know about really great content like this, and subscribe to our YouTube channel. So we have all of us here at Akrinos signing off.